What's up everybody, Gen X Dividend Investor here. In this video I'm going to tell you some really bad news that's brewing, and it's actually something that I warned about in a video I made almost 2 years ago called The Biggest Risk to Dividends. But before you freak out, it's important to understand that there's also a possibility that this news could actually be incredibly good for dividends, so buckle up as I'm going to explain what's going on. Specifically, I'm talking about new tax proposals that are being discussed as part of Project 2025. Now, I normally avoid talking about politics or proposed legislation, but given we are currently seeing unprecedented change happening in our government, I thought it made sense to bring up what I found. And for those that are unaware, Project 2025 is a massive plan to reshape the US government. It's a roadmap for what policies and changes should be implemented, covering areas like immigration, federal government jobs, environmental regulations, social policies, taxes, and more. The current administration has already swiftly enacted several key aspects of Project 2025, particularly in areas concerning environmental policy, federal workforce management, and budgetary allocations, and so it's reasonable to assume that the proposed tax changes have a decent probability of coming as well. Now, it could just be a coincidence that many changes that are happening are aligned to what Project 2025 proposed, as the current administration has somewhat dismissed Project 2025, but several individuals associated with it have been hired in key positions, and bottom line, the data speaks for itself. I mean, you can review the 887-page Project 2025 I linked in the description below, and you can see the exact proposals in it, and then compare those to what's happening right now and find the clear overlap. That being said, an important takeaway is that the proposed tax changes I'm going to show you next may not happen, especially the final big one. And with that out of the way, let's start with an exact quote from Project 2025's PDF regarding taxes. It says, "The Treasury should work with Congress to simplify the tax code by enacting a simple two-rate individual tax system of 15% and 30% that eliminates most deductions, credits, and exclusions. The 30% bracket should begin at or near the Social Security wage base to ensure the combined income and payroll tax structure acts as a nearly flat tax or wage income beyond the standard deduction. The corporate income tax rate should be reduced to 18%. The corporate income tax is the most damaging tax in the US tax system, and its primary economic burden falls on workers because capital is more mobile than labor. Capital gains and qualified dividends should be taxed at 15%, end quote. So let's unpack all of that to make sense of it. Number one, they want to simplify taxes and reduce the number of tax brackets from 7 that we currently have down to 2. For reference, these are the current tax brackets in the US. We have what's called the progressive tax system, meaning you generally don't pay one flat rate on all your income. Instead, your income is divided into chunks, and each chunk is taxed at a different rate. For example, let's pretend you file as a single person who makes $50K a year. This tax chart might make you think that all your income is taxed at 22%, but that's not how things work. First, you get to subtract a standard deduction, which is $15K in 2025, off your taxable income, taking you down to $35K. Then you're taxed at 10% on the first $11,925 of your taxable income, then 12% on your income between $11,925 and your $35K amount, which means 12% of $23,075. So your total federal income tax due would be rounded to $39,662. Those progressive tax brackets, combined with the standard deduction, really help that person out. And you can tell by looking at those brackets that the more income you make, then you get taxed at higher amounts from a percentage basis. But compare that to the Project 2025 proposal, which is to instead simplify things down to 2 brackets, one at 15% for all the income under $176,100, which is about what the Social Security wage base is at, and the other bracket being at 30% for any income above that. So that means lower income folks would make out worse since we lost the 10% and 12% buckets, not to mention the fact that Project 2025 also wants to get rid of most deductions, so that could mean also getting rid of the standard deduction, but I'm gonna assume not based on how they phrase things. The changes also mean that super high income folks make out better because the top tax rate would be 30% as opposed to the 37% they currently have. Okay, so now let's look at the single filer example under Project 2025. First, they reduce their taxable income by $15K for the standard deduction, and then 15% of $35K remaining equals $5,250 of federal income taxes due, which means that the Project 2025 proposal would unfortunately increase that single person's federal tax bill from $3,962 up to $5,250. Ouch. Continuing on, we get to the part of the tax proposal that is potentially quite nasty, and that's having a minimum tax rate of 15% on capital gains and qualified dividends. I mean, compare that to this chart which shows qualified dividend tax rates for 2025, and notice the minimum tax rate is 0%. In fact, someone I was chatting with regarding this new proposal actually felt that it would be a nail in the coffin for dividend investing. Like it's a rest in peace dividend moment, and I get that perspective, but keep watching to see why things could actually end up being hugely beneficial for dividends, even though initially it might be way worse. Okay, so right now, if you're married and filing jointly, and you have $30K standard deduction, then that means you could make $126,700 of qualified dividends in a taxable account and owe $0 in federal income taxes. Basically, you subtract the $30K deduction from $126.7K, taking you down to $96,700, and this chart says that the tax rate on dividends that are $96,700 or less are at 0%. That's a testament to how powerful qualified dividend income can be when it's coupled with our current tax code. I mean, being able to make a six-figure dividend income in a taxable account and still owe literally nothing in federal income taxes is huge, especially if you compare that to what you'd pay if you made that income on a job. Like if you made $126,700 at work and you filed married jointly, you'd owe $11,127 in federal income taxes. And note, I'm leaving state income taxes out of this discussion. Another note, that doesn't mean that qualified dividends aren't ever taxed, and there's a helpful tax estimating calculator I like to use on MoneyChimp, which lets you put in job income and qualified dividend income and non-qualified dividend income to see what your federal income taxes would be. Okay, now let's compare what Project 2025 might do to a retired couple living on qualified dividend income. So instead of a 0% lowest tax bracket, we step up to 15%, and after the standard deduction, they'd owe $14,505 in federal income taxes, which is a massive increase compared to the zero they'd owe today. At first glance, it seems like Project 2025 would materially reduce the ability to get post-tax dividend income for many people, like myself. I mean, I think I'd lose over $1,000 a month of spending money if this change happened. And it's actually even worse than that due to the impact it would have on reinvesting dividends in a taxable account, which would be bad for most investors out there because they'd be paying higher taxes up front on dividends before reinvesting them. But at least retirement accounts shouldn't be impacted since they tend to shield dividends from immediate taxation. I did some quick calculations testing out the proposed changes, and ultimately it seemed that $170K a year as a married couple was the break-even point where if you made less than that, broadly speaking, then you'd fare worse with Project 2025, or if you made more than that, you'd do better, at least in terms of taxes due. For a single person, I think that break-even point is $85K. Now, another change Project 2025 talks about is reducing the corporate tax rate from 21% to 18%, and then they mention the actual biggest change to taxes, which is when it talks about consumption-based taxation. It says, finance literature is clear that a consumption tax would minimize government's distortion of private economic decisions and thus be the least economically harmful way to raise federal tax revenues. It goes on to talk about the different forms that could be utilized for consumption tax, and consumption-based taxation is where things can get really good or bad, both for dividends and for everyone, depending on your point of view. So listen carefully to this next part. Consumption-based taxation is a tax system where people are taxed based on what they spend rather than what they earn. So if we transition to consumption-based taxation, it could mean that they ultimately would get rid of the newly proposed 15% and 30% brackets, as well as get rid of taxes on dividends altogether. And instead of taxing any income from your job or from your investments, the government would instead primarily make tax revenue when consumers buy goods or services. This would obviously be a radical change to our tax system, and usually huge changes don't happen in our government, though given what we are seeing these days, anything is possible. And can you imagine how compelling dividends would become if they weren't taxed at all? That could mean no taxes on your covered call dividends or your REIT dividends or your qualified dividends or anything. The tailwinds that would probably provide for dividend investors and dividend stocks would be quite nice. But while it's true that you'd keep all your income and there'd be no annual income taxes, instead you'd pay something that was like a new sales tax whenever you bought something. Like instead of that dozen eggs being $5 or whatever, it would instead cost $6 or $7 or some higher amount because they'd need to make up that income tax revenue loss somehow. Maybe the government would create a value-added tax where a tax is applied at different production stages, which apparently is more common in Europe. So when companies make a product to sell, they would owe more production taxes on it, which invariably means that they would simply raise their prices and pass the costs on to you, the consumer, which also unfortunately means that lower income people would probably get hit harder because they tend to spend more of their income on necessities. Some countries actually exempt value-added taxes on essential items like food and medicine, or may offer rebates to reduce this burden for items that people need, which can then help lower income folks the most. Like in my eggs example, they might keep the cost at $5 since they determined that eggs are a necessity, and instead put the extra taxes on discretionary items like video games or candy or stuff like that. Though I'd argue that video games are a necessity. Anyway, a nice thing about consumption-based taxes would be that it would probably encourage people to save and invest more, since you're only taxed when you spend. Some economists believe that the increase in disposable income we would get from federal income taxes going away would probably stimulate the economy in the short term, but at the expense of increasing inflation, as costs would tend to shoot up. Plus, there'd probably be a bunch of other impacts to the economy, which could affect compensation and benefits, hiring, and who knows what else. But I think that a massive change like going to consumption taxation would potentially happen after the first tax proposal of simplifying brackets and such, so let's do a few more examples of how the first change might play out. Let's say someone makes $35K a year from their job and $0K in dividend income. Currently, they would owe $2,162 in federal income taxes. Under Project 2025, I calculate that they'd owe $3,000 in taxes, which is a decent amount more. Or how about a higher wage person who's also been investing in dividends? Let's say someone makes $75K a year in their job, and they make $5K a year in qualified dividend income. Currently, they would owe $8,864 in federal income taxes. Under Project 2025, they'd owe $9,750 in federal income taxes. Again, that's pretty harsh, as that's 10% more in taxes due. Now let's go into higher income earners, and let's say someone was making $150K a year at their job and was making $25K in qualified dividends. In 2025, a single person with that kind of income would owe $28,997 in federal income taxes. But under Project 2025, that person would owe 15% on $150K, which equals $22,500, and 15% on $25K, which equals $37,500. So that equals $26.25K in taxes, or $2,747 less than they'd owe in our current system. Note that it's also possible that Project 2025 would only allow the standard deduction to apply to your wage income and not investment income, which could further negatively impact dividends. Finally, let's do a very high income person who is making $1 million a year at their job and was making $300K a year in divvies. They currently would owe $381,470 in federal income taxes. But under Project 2025, they would owe 15% on $300K of dividends, which equals $45,000, plus 15% on $176,100 of their income, which equals $26,415, plus 30% on the remainder of their income from $176K to $1 million, minus the standard deduction, i.e. on $808,900, and 30% of that would be an additional $242,670. So in total, they'd owe $45K plus $26.4K plus $242.6K equals $314,085 in total federal taxes due on their $1.3 million of income. That means they'd save over $67,000 in federal income taxes under Project 2025 versus what happens right now. Basically, what my math shows me is that lower income folks would pay more in taxes under Project 2025, generally speaking, and super high income folks would pay less, at least for stage 1 of the proposal. But I'm not a tax person, so don't take what I'm saying as accurate, especially since the Project 2025 stuff is all just proposed tax changes that aren't official by any means. I did read an analysis that estimated that Project 2025 would raise taxes by about $3,000 for the median average family of 4, i.e. a household that makes about $110,000 a year, and it would raise taxes by about $1,000 for a typical single-person household, which makes about $40,000 a year. But at the upper end of things, we'd see 45,000 households in the US that make more than $10 million a year. They would get savings of $1.5 to $2.5 million. I asked Grok on X what the impact of Project 2025's tax changes would be for the average American, and it said that they'd see a slight tax increase, which seems to align with my analysis as well. I also read that in terms of a consumption tax, the estimate was that the impact would be like an additional $5,900 in federal taxes due for the middle 20% of households, though it would be a $2 million tax cut for the top 0.1% of income households. One side benefit to investors is that Project 2025's proposed changes for lowering corporate income taxes would mean that the Fortune 100 would get something like a $24 billion tax cut, which includes many dividend companies that you and I tend to invest in. So for companies I own, that would be something like a $1.3 billion tax cut for ExxonMobil and Chevron, a $1.6 billion tax cut to Johnson & Johnson and AbbVie, and a $2.1 billion tax cut for Goldman Sachs, etc. Project 2025 would also repeal the recent stock buyback tax that went into effect, so that would be a benefit to companies and us as well. Bottom line, proponents to Project 2025's tax changes contend that these reforms would simplify the tax code, promote economic growth, and enhance competitiveness by encouraging investment and savings. They argue that the changes would stimulate business activity and attract foreign investment. People against Project 2025 say that lower income folks would end up with less in their pockets and that the rich just get richer. I like the idea of promoting saving and investing more, but I'd be against things that would end up hurting lower income folks. Now, tax changes could be implemented in a way that benefits everyone, so hopefully if anything does happen, then it'll move things in a positive direction for everybody. Of course, we also got to recognize that if taxes are reduced, generally speaking, then that also has impacts on our society that we need to contend with. Regardless of what they do, I'm confident that if you invest in good assets, then you'll probably make out quite nicely in the long run. And there's still a lot of unanswered questions with all this, so it'll be fascinating to see what happens. For example, would REIT taxation change? Like if you held realty income in a taxable account, would it be taxed like qualified dividends then? Or what would happen to MLPs? I mean, they currently basically do a return of capital as your cost basis gets lowered, so would those sorts of partnerships lose their tax treatment? My MLP, Enterprise Products Partners, which I bought in early 2023, has given me about $20,000 in cash distribution so far, and I've gotten to pay $0 in federal income taxes on any of it. But if Project 2025 happened, would they do a carve-out for MLPs, or would they suddenly be taxed at 15%? My guess is that since Project 2025 follows a pro-business, pro-energy agenda, MLPs, especially in oil and gas infrastructure, might retain their tax-advantaged status as an edge case. Maybe they'd implement some sort of pass-through deduction like the 2017 Tax Cuts and Jobs Act had. Or maybe MLPs would end up converting into traditional C-Corps, kind of like what Kinder Morgan did a decade ago. Investors who held Kinder Morgan MLP in their taxable accounts were hit with unexpected tax bills due to the depreciation recapture, which converted much of their deferred income into ordinary taxable income upon the conversion from being an MLP to being a C-Corp. But an upside to that conversion was that it attracted a broader base of investors beyond MLP-focused ones as they started paying dividends instead of distributions. Anyway, another question I had about Project 2025 is what would happen to Roth accounts if the consumption tax thing happened? I mean, basically every taxable account would become a Roth, only taxables would be better because they wouldn't have all the Roth limitations. I mean, taxables would have no contribution limits, no early withdrawal penalties, no required holding periods, no income limits, and more investment flexibility. Crazy to think about. Now, if the first part of Project 2025's tax changes happened, i.e. the 2-bracket and qualified dividend income change, but not the consumption tax change, then I'd assess if my new dividend income stream was enough for me and my family, and if so, then I'd probably not change much, if anything. If not, then I might do things like sell out of some of my super low yield tickers like my Apple and Microsoft positions, and move that cash into higher yielding things that I still felt comfortable with. Yes, my portfolio's growth would probably suffer, but I'm retired, so growth isn't my primary concern as much as sustainable passive income is. Maybe I'd push more into MLPs, assuming they don't get impacted. Or maybe I'd do a 72T to offset my increased taxation, and by doing that, then I'd not have to keep paying the 10% early withdrawal penalty I'm currently paying. You see, one big reason I've not done a 72T yet is because I've thought that it would be nice to do Roth conversions if I come into some material amounts of cash in the future. A 72T, also known as substantially equal periodic payments, allows you to withdraw from a traditional IRA before age 59.5 without the 10% early withdrawal penalty. But once you start, you must stick to the set withdrawal schedule at least until age 59.5 or for 5 years, whichever is longer. So I kind of like the optionality I currently have, being able to hopefully eventually convert my entire traditional IRA into a Roth IRA via using outside cash, and the cost I'm paying for that optionality right now is the 10% early withdrawal tax. Anyway, another interesting item in Project 2025 that's relevant for this video is that they propose that all taxpayers should be allowed to contribute up to $15,000 adjusted for inflation of post-tax earnings into universal savings accounts, or USAs. The tax treatments of these new accounts would be comparable to Roth IRAs. USAs would be highly flexible to allow Americans to save and invest as they see fit, including in private businesses. Gains from investments in USAs would be non-taxable and could be withdrawn at any time for any purpose. That all sounds pretty good, though I wonder if they would eliminate some tax advantages that HSAs have if they put these new USAs into place. Whatever happens, we investors just need to keep pushing forward. Sometimes changes will benefit our holdings and investment strategy, and sometimes they won't. Nothing is set in stone, and even if they make all these proposed changes, the only thing I know is that it will eventually change again in the future. And just like nothing is set in stone when it comes to tax policies, it's also important for me to call out that your future hasn't been set in stone either. So dream of the future you want, and then build towards realizing that dream. Maybe your investments can be part of the foundation of your dreams. Perhaps your dividend cash flow can help you get to where you want to go. So dream it, build it, and live it. Listen to what others say, but ultimately craft your own path based on what you believe makes sense for you. You'll come across people who will dislike your investing strategy, and maybe they'll have some valid points, but they also might not understand the full picture of things. Like I recently posted about how Realty Income, which is about 6.4% of my portfolio, just announced a 1.5% dividend hike, and that they usually do multiple smaller hikes during the year. Someone LOL'd that hike as being low, and I don't fault them for saying that. I mean, 1.5% doesn't beat inflation, and if total annual hikes aren't usually beating inflation, then you can understandably be concerned. Plus, Realty Income has done very poorly over the last 5 years as compared to the broader market, but it's also important to look at how it's done as compared to other REITs. I mean, WP Carey increased their dividend for 24 consecutive years, and were on the verge of becoming an aristocrat, but then they cut their dividend due to the pandemic and the impact that they were having at their office-based properties. But Realty Income split off their assets into Orion, and instead of a dividend cut, the next day they announced a 5.1% dividend hike. Or think of Global Net Lease, which is a REIT that cut its dividend when the pandemic hit, and then cut again in 2023 and cut again in 2024. Or Paramount Group, another REIT, which cut its dividend last year. Or Ready Capital Corporation, a mortgage REIT, that reduced its dividend last year as well. My point is that yes, most REITs have had bad performance in the last few years, primarily due to the pandemic along with higher interest rates, but at least O has continued to increase their dividend, showing that they're a stronger company. So seeing even their 1.5% dividend increase is actually something to be a bit impressed about. I still remain long on Realty Income, and I appreciate that they've been able to grow their dividend for so many consecutive years, and I think eventually their stock price will trend up again as well. So for now, I'm sitting tight as they continue to pay me over $1,000 a month in divvies, and I hope that someday my eventual grandkids will also be getting paid for my real estate investment, all without them having to manage any tenants or deal with leaky roofs or anything like that. But I don't know what the future will bring, and the reality is that Oak could scuttle their dividend tomorrow, so never invest without understanding the risks of what could happen. And to end this video, I ask you to please leave me a comment telling me what you think about the proposed Project 2025 changes. Do you like the idea of going from 7 tax brackets down to 2? Would you like us to adopt a consumption tax instead of an income tax? Please don't get political in the comments, just tell me what you think and what you'd do if you could actually call the shots. I think this is a really fascinating topic, so your feedback would be really interesting for me to see. Also, please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now I'd like to do a shout out to Humble Enthusiasm, who just signed up as a Patreon aristocrat. I'd also like to recommend that everyone check out my Fast Graphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. I'll also recommend that you check out my Seeking Alpha affiliate link, as new users often get benefits for signing up. Finally, please check out my Patreon page, and or consider joining my channel membership, as both have some cool perks you might like. Whatever you do, don't forget to join my free Dividend Discord chat server, which has over 11,000 Dividend investors on it from 84 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.